What if the biggest mistake beginner dividend investors make has nothing to do with picking bad companies, but with asking the wrong first question? Most beginners ask, what stock pays the highest dividend today? But sophisticated investors ask something completely different. Which business can keep raising my income for the next 20 years without destroying its balance sheet? That difference changes everything. Because a 7% yield can quietly become a financial trap, but a 3% yield growing consistently through dividend growth investing can evolve into a massive passive income machine through compounding. The real goal is not to maximize this quarter's dividend payment. It's to build durable cash flow capable of surviving recessions, inflation, rising interest rates, and market crashes. And that requires something most beginners completely ignore: free cash flow, payout ratios, competitive moats, and sustainable dividend growth. Today, we're breaking down the biggest mistakes beginner dividend investors make before they destroy years of compounding. Using SCHD, Johnson & Johnson, Procter & Gamble, and Realty Income as real-world examples. We'll analyze the difference between chasing yield and building true long-term financial freedom. Let's start with SCHD, the Schwab US Dividend Equity ETF. SCHD is not a stock, but for many beginners, it is a disciplined gateway into dividend growth investing. Its official expense ratio is 0.06%, and it tracks the Dow Jones US Dividend 100 Index. Recent dividend data shows a yield around 3.3% and a 5-year dividend growth rate near 8.7%. Next is Johnson & Johnson, ticker J&J. J&J recently announced its 64th consecutive annual dividend increase, with an indicated annual dividend of $5.36 per share. Current data places its yield around 2.2% to 2.3%, with a payout ratio near 56%. Then Procter & Gamble, ticker PG. This is a dividend king, with 70 consecutive years of dividend increases. Recent data shows a dividend yield near 3.0%, a 5-year dividend growth rate around 6.1%, and a payout ratio around 63.6%. Finally, Realty Income, ticker O. Known as the monthly dividend company, Realty Income offers a higher yield, recently around 5.0% to 5.3%. Its 5-year dividend growth rate is around 3%, and its 2025 dividends represented about 75.2% of diluted AFFO, which is more relevant than earnings for REITs. Now imagine a beginner investor builds a $100,000 dividend portfolio with a blended starting yield of 3.5%. That creates $3,500 in first-year dividend income. But the real engine is not the first year. The real engine is dividend growth. If that income grows at 6% annually, after 10 years, the income rises to roughly $6,267 per year. After 20 years, it becomes about $11,224 per year before considering reinvestment. That is yield on cost. The original portfolio still began at 3.5%. But 2 decades later, the income on the original capital could represent more than 11% annually. This is why dividend growth investing is not about chasing today's yield. It is about buying future income at a rational price. Dividend Aristocrats and Dividend Kings matter because they show a culture of shareholder returns. But the title alone is not enough. The investor still needs free cash flow, a durable moat, reasonable valuation, and a payout ratio that can survive recessions. Here is where beginners fail. They confuse dividend yield with dividend quality. A high yield can mean one of two things. Either the company is genuinely undervalued, or the market is pricing in risk before the dividend gets cut. The second case is the classic dividend trap. A payout ratio above sustainable levels is a warning. Weak free cash flow is a warning. Debt-heavy business models in a high-rate environment are a warning. And valuation still matters, even for elite companies. SCHD reduces single-company risk, but it still owns equities and can decline in bear markets. J&J has quality, but healthcare litigation and growth pressure matter. PG has a powerful consumer staples moat, but slow growth can limit upside if valuation is too high. Realty Income has monthly income appeal, but REITs are sensitive to interest rates and capital costs. The solution is not fear. The solution is discipline, diversify, demand dividend growth, monitor payout ratios, and avoid buying income without understanding the business behind it. This script explains the critical difference between high dividend yield and dividend quality, warning against common pitfalls like dividend traps, indicated by unsustainable payout ratios, weak free cash flow, and excessive debt, especially in high-rate environments. It cites specific company and ETF examples, SCHD, J&J, PG, Realty Income, to illustrate how even quality assets carry risks. The script concludes by advocating for financial discipline through diversification, demanding dividend growth, monitoring payout ratios, and thoroughly understanding the underlying business before investing for income. The real question is this: would you rather own a portfolio that looks impressive today, or one that quietly raises your passive income stream for decades? Beginner dividend investors fail when they chase yield. Serious dividend investors study the engine behind the dividend: free cash flow, payout ratio, Moat, balance sheet strength, expense ratio for ETFs, and long-term compounding. Now the question for you: which matters more in your portfolio today? Higher current income or faster dividend growth? This content is for educational and informational purposes only and should not be considered financial, investment, tax, or legal advice. Always conduct your own research and consult a qualified financial advisor before making investment decisions.